Welcome back everyone. So in this session, we will talk about the still conceptual framework for financial reporting. Again, I am your professor, your lecturer, Dale C. Eason, CPA-CTT. So we've already tackled um, chapters 1 to 4 of the conceptual framework. And for this session, we will talk about the recognition and the recognition. So let's start. Let's first define what is the recognition process. Okay. So recognition is the process of including in the statement of financial position or the statement of financial performance an item that meets the definition of one of the financial statement elements. For example, your asset, liability, equity, income, or expense. Okay. This involves recording the item in words and in monetary amount and including that amount in the total assets of either those statements. So the amount at which an asset, a liability, or equity is recognized in the statement of financial position is referred to as its carrying amount. Recognition links the elements, the statement of financial position, and the statement of financial performance as follows. So here in the diagram below, you can see here the statement of financial position at the beginning of the reporting period. So this is your January 1, okay? January 1, okay? And then add all of your net changes in your assets and liabilities. So and record also your equity. So this is for the year, okay? For the year. Okay. And then you add your statement of financial performance. Okay? Again, this is at the beginning of the year. Here, 1/1/2001. And then add also your income minus expenses, so that would be your net income. Okay? And include also in your statements of financial performance are the contributions from holders of equity claims minus the distributions to holders of equity claims, or the contributions would be your investment by your investors, okay? And your distributions are your dividends, okay? So add the net changes in your statement of financial position plus your changes in equity. You would get your statement of financial position at the end of the reporting period, or this would be your December 31. Okay? So December 31 if the accounting policy is using a calendar year. You also may refer to this diagram in the conceptual framework document. So the statements are linked because the recognition, okay, here, I'm flashing back again the table. The statements are linked, this, these three, or these are linked because the recognition of one element or a change in its carrying amount requires the recognition or the recognition of another elements. Okay? So first, example. Example here, you have a recognition of income resulting in an increase in asset. Okay? So there is recognition of initial recognition of an asset or increase in the carrying amount of an asset. Okay? So sorry, this should be income. Apologies. That should be initial recognition of an income or an increase in an asset. Okay, for one example would be recording a sale. Increases your both cash or AR and sales income. Okay, so when you record the sale, right, you debit cash, or if it's in credit, you debit accounts receivable, and the corresponding credit would be your sales or your revenue. Okay, so that is an example of an increase in income. Okay, initial recognition of an income which results to an increase in the carrying amount of an asset. Okay, so next is the recognition of a liability or a decrease in the carrying amount of a liability. Okay, so an example of that would be an unearned income. Okay, so earning an unearned income, okay, decreases your unearned revenue, which is a liability, which then again increases your income. Okay, so in this, it's like your customer has already an advance payment to you, so you have to extinguish that obligation. You have to perform such service or deliver such goods. Okay, so the moment that you render that service or deliver that goods, you would now be debiting your unearned revenue, and you would now recognize an income account in the form of revenue or sales. Okay. Third scenario is when you initially recognize a liability or an increase in the carrying amount of a liability. For example, accruing unpaid salary increases both salary expense and salaries payable. Okay, so meaning of accruals, it means you have already consumed the services or the item even though you haven't paid for it yet. Okay, so when we recognize unpaid salaries, we debit salaries expense, okay, and have a corresponding credit entry of salaries payable, which is in the form of a liability. Okay, so in this point, we have um, the recognition of an expense, okay, and the recognition of a payable or liability. So last example would be a derecognition of an asset or a decrease in the carrying amount of an asset. So example of which are your supplies expense. Okay. So when you purchase payment for supplies expense increases your supplies expense account or a decrease in cash. Okay. So that would be an example of your recognition of an asset or a decrease in the carrying amount of an asset. Sometimes, the recognition of income results in the simultaneous recognition of a related expense. This simultaneous recognition of income and expense is also called matching of cost and income, or your matching concept. For example, the sale of good results in the simultaneous recognition of sales, which is an income account, and cost of sales, which is an account for the expense. Again, take note of this concept, which is the matching concept. An item is recognized if, first, if it meets the definition of an asset, liability, equity, income, or expense, and recognizing it would provide useful information, for example, relevant and faithfully represented information. Both the criteria above must be met before an item is recognized. Okay, so in order that the item would be recognized, both recognition criteria should be met. Okay, so it must not be or, but instead it should be and. Okay, so it must meet the definition, and it should it should provide useful information. Okay, it should hit the two criteria and not just one. Accordingly, items that meet the definition of a financial statement element but do not provide useful information are not recognized, and vice versa. As I've said just a while ago, um, it should meet the two criteria. Okay, highlighting this word and. Okay, so if the item meets both being relevant, having relevant information, okay, and it would also provide useful information, you would be recognizing it as an account in your statement of financial position or in your statement of financial performance. However, if it does not meet one of the one of one of the any one of the criteria above, um, for example, this is or, you would not be recognizing it in your statement of financial position or your statement of financial performance. Providing information as well as using that information entails cost. For example, The reporting entity may incur cost in appraising its property for measurement purposes. Users spend time and effort in analyzing and interpreting the information. Thus, an entity should consider the cost constraint or the cost-benefit principle when making recognition decisions such that the usefulness of the information justifies its cost. It is not possible, however, to establish a uniform threshold for determining an optimum balance between cost and benefits. This would depend on the judgment and the facts and circumstances. Accordingly, judgment is required when deciding whether to recognize an item, and thus, the recognition requirements and standards may need to vary. Even if an item that meets the definition of an asset or liability is not recognized, information about the item may still be need to be disclosed in the notes. In such cases, the item is referred to us as unrecognized assets or unrecognized liability. The recognition of an item may not provide relevant information if, for example, first, it is uncertain whether an asset or liability exists, or an asset or liability exists but the probability of an inflow or outflow of economic benefits is low. Existence uncertainty or low probability of an inflow or outflow of economic benefits may result in, but does not automatically lead to the non-recognition of an asset or liability. Other factors should be considered. If one or both of the foregoing factors result to non-recognition, information about the unrecognized asset or liability may still need to be provided in the notes. For example, for information about the existence uncertainty or the possible inflows or outflows. Despite the presence of one or both the foregoing factors, an asset or liability may nonetheless be recognized if this provides relevant information. For example, the cost of an asset or liability arising from an exchange transaction on market terms generally reflects the probability of an inflow or outflow of economic benefits. Thus, the asset or liability may be recognized because not recognizing it would result to the recognition of income or expense which may not faithfully represent the transaction. So what is faithful representation in terms of recognition and derecognition? The recognition of an item is appropriate if it provides both relevant and faithfully represented information. Again, both relevant and faithfully represented information. The level of measurement uncertainty and other factors, such as representation and disclosure, affect an item's faithful representation. An asset or liability must be measured for it to be recognized. Often, measurement requires estimation and thus subject to measurement uncertainty. The use of reasonable estimates is an essential part of financial reporting and does not necessarily undermine the usefulness of information. Even a high level of measurement uncertainty does not necessarily preclude an estimate from providing useful information if the estimate is clearly and accurately described and explained. However, an exceptionally high measurement uncertainty can affect the faithfulness representation of an item, such as when the asset or liability can only be measured using cash flow-based measurement techniques, and in addition, one or more of the following circumstances exist. A. There is an exceptionally wide range of possible outcomes and each outcome is exceptionally difficult to estimate. B. The measure is highly sensitive to small changes in estimates of the probability of different outcomes. C. The measurement requires exceptionally difficult or exceptionally subjective allocations of cash flows that do not relate solely to the asset or liability being measured. So for your last slide, we have here the derecognition. So the recognition is the opposite of recognition. If in the concept of recognition is recording and presenting it in our statement of financial position and statement of financial performance. So this would be the opposite of recognition. Okay, by the it can be self-explanatory by the word recognition that we would be eliminating this in our financial reports. The recognition, again, is the opposite of recognition. It is the removal of a previously recognized asset or liability from the entity's statement of financial position. The recognition occurs when the item no longer meets the definition of an asset or liability, such as when the entity loses control of all or part of the asset, or no longer has a present obligation for all or part of the liability. On the recognition, the entity may recognize the asset or liability that have expired or have been consumed, collected, fulfilled, or transferred. For example, your transferred component. Okay? No income or expense and recognizes any resulting income and expense. Letter B, continues to recognize any asset or liabilities retained after the derecognition, which is called your retained component. No income or expense is normally recognized on the retained component unless there is a change in its measurement basis. After the recognition, the retained component becomes a unit of account separate from the transferred component. So in this slide, take note of the terminologies transferred component and your retained component. Okay? So for the retained component, um, um, a unit of account exists because of the retained component. Okay? So what is unit of account? Unit of account is the right or the group of rights, the obligation or the group of obligations, or the group of rights and obligations to which recognition criteria and measurement concepts are applied. A unit of account can be an account title such as cash or accounts receivable, or a group of similar assets like your property, plant, and equipment, or a group of assets and liabilities like your cash generating unit or your CGU. A unit of account is selected for an asset or liability when determining how that asset or liability and the related income or expense will be recognized and measured. For example, cash is recognized when it is either on hand or deposited in the bank and is measured at face amount, while accounts receivable is recognized when a sale occurred and is measured at the transaction price adjusted for any uncollectible payment. If an entity transfers part of an asset or a part of liability, the unit of account may change at that time, so that the transferred component and the retained component become separate units of account. Okay? So, again, the two terminologies that I ask you to remember are the words transferred component and retained component. So, what is transferred component? Okay? The recognition is not appropriate if the entity retains substantial control of a transferred asset. In such case, the entity continues to recognize the transferred asset and recognizes any proceeds received from the transfer as a liability. If there is only a partial transfer, the entity then recognizes only that transferred component and continues to recognize the retained component. So take in mind again, guys, um, that for every account, there should be you must first determine if it would be needed to be recognized or not. Okay, so take note of the recognition criteria. Again, what is your recognition criteria? First, it meets the definition of an asset, liability, equity, income, or expense, and recognizing it would provide useful information, okay, which should be relevant and faithfully represented information. So if one criteria is not met, then this would not be recognized in your financial reports. So hope you understood our topic for recognition criteria. It's um, basically is straightforward. While your derecognition process is also straightforward, if it no longer meets the definition of an asset or liability, eliminate it or remove it in your statement of financial position. Okay. However, if just a part of your asset and liability is extinguished, you have your retained component, which is a separate unit of account.